Good evening, everyone. Welcome to this Property Club webinar. Thank you for spending some of your time with us. Tonight, we're going to talk about property finance. I can see that we've got quite a few people already online, and no doubt we'll have a few stragglers come in over the next couple of minutes. For those who don't know me, Michael Brooks is my name. I look after the Property Club in South Australia and some of the regions of Victoria. And tonight's webinar is really in response to demand from you, the Property Club members, letting us know that you wanted to talk more about property finance. And I think it's a really interesting topic to listen and talk about because there are so many changes and things change every day. I'm fortunate in the role that I perform that I get to speak to mortgage brokers and clients, probably every day, every couple of days. So I'm a bit attuned to what's going on, but even then I'm surprised by the sorts of things that I hear that lenders are doing. So tonight's kind of very much that opportunity for you to listen. We've deliberately not organised a long presentation with a view that you might contribute your questions as we go, and we might do a bit of a Q&A session at the end. Now, for those of you who are not entirely familiar with the GoToWebinar platform that we're using tonight, you've got a little sidebar, and if you click and expand it, there's a tab that says questions. So you can type in your questions, and your questions will come straight to me. So the plan for tonight will be that while our guest speaker is talking, if you put some questions in that box, then we'll go through and deal with them at the conclusion of the formal part of the presentation. So I encourage you to do that. Otherwise, you can, of course, email us at the end of the presentation if you want some more specialised advice or you don't want to ask a question tonight. So I just thought I might introduce then Joe Linko and his business Concise Finance. Certainly, in the time that I've been around the Property Club, we've had a number of different mortgage brokers come and go. And I'm very pleased that Joe has been around the club for a long time and continues to be. There's no error or no mistake with the fact that this finance update focuses on low rate and on great client service, because that's exactly what Joe's business does provide. And I'm saying that from the perspective of Joe and his guys helping my clients in the Property Club, but as well as that, I think it comes with a bit more credibility when I tell you that he's actually my own mortgage broker, and we have restructured and changed my own lending with his support over time. So I can speak from a genuine experience about Joe. He's been in the finance sector for a long time. He's been around property for a long time, and I've really appreciated his expertise. And sometimes with a mortgage broker, it's about their ability to fix problems or come up with creative solutions that I guess differentiates one from another. So again, a strength of Joe. So I'm going to throw to Joe, and I'll just remind you that if you can start those questions coming, we'll have some time at the end to go through them. So I'll just change presenters over to Joe. Thank you, Joe.
Thank you, Michael. Yep, so while Michael's doing that, I've been working with the Property Club now since 2007, and we have helped quite a few clients, sort of refinance and lower the interest rates, etc. So let me just get this presentation going for you tonight. So some of the things that we're going to focus on tonight are some of the important changes and some of the important things that we need to know when we are looking to buy a property or we're looking to refinance. It's certainly not as easy as it used to be. And some of the things that we're talking about tonight, we'll just let you know how our landscape in finance has changed. So, we're going to cover four main things. So we're going to cover comprehensive credit scoring, which some of you may have heard about and some of you may not have heard about. But that's something, you know, that's come in, and it's very, very important that we know our credit score before we actually apply for finance. Then we're going to have a look at the concept of HEM, you know, and living expenses and how they're playing a very, very important role in today's finance market. We'll have a look at some of the changes to lending criteria, you know, what's happened, the good, the bad, and the ugly. And lastly, I'll just have a quick chat to you about the importance of getting a financial health check done on a regular basis. So like Michael said, if you've got any questions, feel free to pop them, you know, sort of into the actual question box. And at the end, I'll see what I can do to give you a hand. But before we do start, you know, this is a quick disclaimer. So the information, you know, that I'm going to talk about tonight is general. Okay, so we haven't had a look at people's circumstances. So if you would like me to have a closer look, you know, at the end, I'll let you know my details, and send through an email. Or have a chat to your property mentor, and they can send, you know, your finance form over to me, and we can see what we can do. So let's start off with our comprehensive credit scoring, you know, and what is it? So comprehensive credit scoring is a system now that the banks use to decide whether or not you're going to be a good client or a high risk client. So it's basically based on good credit behaviour. So these days, lenders can see on your credit file, you know, how often you repay your loan, and they can also see, you know, if you're late on your loan repayments too. But comprehensive credit scoring, it allows you as a consumer to take greater control of how, you know, a potential lender is going to, you know, have a look at your application, you know, when you put it in for finance. So credit reporting now, so it's a system, you know, whereby the banks by law have to share your information with credit companies now. So up until about 6 months ago, there were some banks that were doing it, some banks weren't doing it, but now it's law, and the banks have to send your information through to the credit company, so that when you're applying for finance, you know, there's a full report of your debts, what you owe, you know, what your repayments are, so that the you know, the lender that you're applying for finance for has a clear picture of you. So one of the big things, you know, is that previously on your credit file, you know, the banks could see how many credit cards you had and, you know, how many loans you had, but they couldn't actually work out whether or not you know, made your repayments on time. And these days, if you're going for a refinance, there's some banks out there now that won't even ask you for your bank, you know, your last 6 months bank statements, because, you know, everything that they need to know is going to be on your credit file. So by being able to, you know, have a look at you and your credit report, lenders can now, you know, sort of make a better decision as to whether or not you're going to be a good risk or you're going to be a bad risk. So some of the ways you can improve your, improve your credit score is lower your credit card limits. You know, we see clients that have got credit card limits up to 60, 70,000, and, you know, they don't even use those cards. Okay, but when you're going for finance, and the bank has a look at your credit report, they see all these credit cards on there, you know, you will be deemed as a higher risk. But the other thing is that from a serviceability point of view, when you've got $70,000 worth of credit cards, but, you know, you never ever use them, the bank will assume that those credit cards are fully drawn. Okay, so it means that, you know, they're going to assume you owe another $70,000 worth of debt at very, very high interest rates, and that there does cripple a lot of people's borrowing capacity. So if you don't need your credit cards, if you don't need those limits, reduce them, or just to get rid of those credit cards. Consolidate your personal loans, okay, or as I said, your credit cards also. So if you've got quite a few, you know, personal loans out there, what a lot of people are doing at the moment is that they're consolidating those, you know, into the home loan if they've got equity, and we set it up as a totally different loan for them. And, you know, it's positive because you're paying a much lower interest rate than what you're going to be paying on a personal loan and on a credit card. But more importantly, when the bank has a look at your credit report, they're not going to see, multiple credit cards and personal loans on there. Limit your applications for credit. So don't go putting in pre-approvals with, 3, 4, 5 different banks. Okay, because every single time you apply to a bank to get a pre-approval, that bank's going to do a credit check on you, and it is going to affect your credit score. So certainly have a chat to your bank or your broker, and just make sure that you can, get the finance before you put the application in. What we're doing at the moment, for some of our clients, where we do need to check things, we are sending it to the bank's scenario team to have a look at it first, and then we're getting them to give us their view on whether they think that the deal is going to work or not, and some of the things that we can improve, and then we're going back to the clients. Now that can take quite a lengthy process because the banks are running behind, but it's better than putting in applications everywhere and marks going on your credit file. Make your repayments on time. So a lot of people, when we have a look at their credit report, they are behind in their loan repayments, and not by much, because a lot of people, if their credit card, payments are due on a certain date, or their home loan payments due on a certain date, what they're doing is they're going, oh, look, it doesn't really matter. I'll pay it 3, 4 days later. So yet you're still making your repayment, but at the end of the month, when the bank has to send your details through to the credit reporting agency, it will show, you making late repayments. So when you're going to apply for a loan, the incoming lender's going to see that, and they're going to wonder, whether you're a good risk or whether you're going to be a bad risk. So what we're saying to people is that if you've got regular payments that you're making manually, why not set up a direct debit, 1 or 2 days earlier to make sure that those repayments, they are made on time, because they will affect your credit score. So same, even with your rent, all your bills and things, just make sure they're paid on time, set up direct debits, paying your mortgage and other loans on time, and pay your credit card off in full each month, okay? Because again, the banks will be able to see if you are paying your credit card off, or so whether you're just making the minimum repayments on it. So on the screen there, you can see an example of what a person's credit score might be. And there's 3 very, very important things that the lender is going to have a look at. And if you haven't seen your new credit report, you can by all means, email me, or you can email your property mentor if you want, your driver's license, and we can, do the credit check for you. We can send it through to you, and then we can give you a call, and we can have a chat to you about it. So the very first thing that the bank's going to have a look at is your credit score. So if it's 930 in this particular case, it's in the green. That's pretty good. However, if it starts to float into the yellow and the red, then there could be potential problems. So another thing the bank's going to have a look at is this part down here. So this is a percentage of chance, that you're going to default on your loan in the next 12 months. So in this particular case here, it's less than 1%, okay, which is good. But if your loan repayments are late all the time, then that will be much, much higher. And we have seen that on some credit reports. And we've told the people to wait 6 months, to make sure that all their loan repayments are made on time, so that this percentage chance down here, it does decrease. And the last thing that they're going to have a look at over here is your RHI score. Okay, so that's called your repayment history. So in this particular case, this credit file is showing that this particular person has never ever been late on any of their repayments. Okay, so when the bank has a look at the first page of your credit report, they can see, okay, well, this person's got a score of 930, great. They're a very, very low risk of defaulting, that's great. And then they're going to have a look at your worst repayment history, 0. And and they're going to feel a lot more confident of giving you the loan. However, if your credit file looks like this, okay, so your score is 429, so it's floating into the yellow, getting close to the red. You've got a 17% chance in this particular case of defaulting in the next 12 months. Now, so that's pretty high to a bank. And the reason why it's so high is because, this particular person, they have been late in their repayments. So you can see down here, that they've got a score of 2. They've got a 17% chance of defaulting, and their credit score, isn't crashed right now. Does this mean that the bank's not going to do the loan? Well, no, but it does certainly mean they're going to have a lot closer look at it. So, if you haven't seen your credit report lately, very, very important to have a look at these 3 things. Number 1, your score. Number 2, your chance of defaulting in the next 12 months. And lastly, your repayment history, okay, to make sure that that is 0. And if yours is up to 2, 3, 4, whatever, then, we can have a chat to you and we can tell you, what you need to do to make sure you fix it before you apply for finance. So with comprehensive credit scoring, so this is what the banks can see. All right, so in this particular case, it's a Westpac loan. They can see what your account number is. They can see the date you opened it. They can see if it's still open or if it's closed. They can see what you owe on it. And, so in this particular case, they owe about 309, and they started off with 321, which is on the right-hand side. So, that's the kind of depth the banks can see now, on your credit report. So, but down the bottom there is your repayment history. So you can see that, every single time, you got a late repayment, it's going to show up as an R, which is arrears. And on this particular one here, we did this one on purpose because from April through to October, it's 0, and then they started making sort of repayments in November because they had a repayment holiday. So the banks, are now able to have a very, very good picture of you as a consumer. So very, very important to make sure that that credit report is nice and healthy. So let's move on to HEM. So we've heard, I guess, that if you've been talking to brokers, banks, the news and stuff, living expenses are quite a hot topic at the moment. And the banks now, they are quite particular, and they do want to see a lot more information around living expenses than they did previously. So HEM, HEM is a household expenditure measure. All right. So what HEM gives the banks an indication of is how much a person as a single person will spend, what a couple will spend, what a couple with 1 child, 2 child, 3 children will spend. But HEMS, does have a lot of flaws in it. But the fact of the matter is that the fate of your application can rest on, this expenditure and on living expenses. So, there was a Royal Commission a couple of years ago, and they had a very, very look close at HEM, because HEM, whilst it gave the banks a good idea, it underestimated non-essential living expenses, okay? Because we all know that a couple with 2 children can be very, very different to a couple with 2 children, okay? Because the first couple may send their kids to public schools. The second might send their kids to private schools, The first couple may not go on holidays. The second couple may go on lots and lots of holidays, So everybody lives different lifestyles and has different expenses. So HEM, has now become outdated. It's still there in the background, but the banks rely on a lot more information to actually decide what your living expenses are. So if you are going to apply for finance, there's a couple of things that we can do. And we can either send you this budget planner, and you are able to, go through, and you are able to, fill this in as accurately as you possibly can, okay? Because when we're first doing your capacity, this will give us a pretty good idea. But as we get further and further, into the process, quite often we do have to ask people for the last 3 months account statements that their pay goes into. And if they've got credit cards, we need the last 3 months of credit card statements also, so that, we can have a look and just doubly make sure that the living expenses are around about what you've declared, okay? Because the thing is that if we don't do it, then the bank's going to ask, for the credit card statements and your pay statements again, and they will go through it, and they're going to be able to work it out anyway. So we might as well do that first, and just try and pick the eyes out of it, and just see if it's going to work with that particular lender. If it doesn't, then there are other options out there. So what we're saying to people is that non-necessary expenses like credit card debt is one of the most important things that you have to get under control. If you don't need credit cards, get rid of them, okay? Because people do live on credit cards. The banks know that, and that's why now they are asking for all these statements to prove that your living expenses are what we as a broker and you as a consumer are declaring. So some of the other changes to lending is interest rates for investors. When the Royal Commission happened, the banks were forced to raise the interest rates for investors, because they wanted to slow the economy down, and they wanted to slow, sort of housing prices down. So they raised the interest rates, about 0.5 to 0.6% higher than owner-occupier. Now, with rates being at all-time lows, the interest rate for investors are still higher, but they're not too bad now. And we can generally save people a lot of money if we can get the figures to work. Interest-only loans, a lot of us, your loans may be coming up to expiry now, and you may want to get interest-only again for another 5 years. It used to be that, you can just call the bank and the bank would go, yep, no worries, we'll give you another 5 years. But nowadays, under best interest duty laws, the banks now have to reservice you again. So if the serviceability isn't there to extend your loan for another 5 years, then, you will go on to principal and interest. Now, if that is happening to you, and I know that we are working with a lot of people at the moment, trying to work out, so which banks, we can take them over to reset the interest-only periods. But, this is something that, so is happening more and more now, where people don't have the serviceability to be able to, retain their interest-only period, and they do have to start to pay principal and interest. Now, is this the end of the world? Well, not necessarily, because I'll show you some of the interest rates in a minute for principal and interest for investors, and they are very, very low also. Changes to documents that are required. So nowadays the banks want to be able to see everything. So like I said, the banks do want us to provide 3 months bank statements to show what your living expenses are, 3 months credit card statements. But, some of the banks are now even asking for, for all your debts. They want the latest month statement of that too, to just make sure that all your repayments are on time and that the debts that you've declared are, what they are. But what they're saying is that by the start of 2022, if, all the IT things go according to plan, the banks won't even have to ask you for your pay slips anymore. They won't even have to ask for your bank statements anymore, because comprehensive credit scoring will have everything on there. So all you will need to do is fill out a loan application, and we as brokers have to do the serviceability. But documents that we're asking for now in 6-7 months time may no longer be required. And this is one of the interesting things that's come up now, is that with a lot of banks, if you're over 50, and with most banks over 55, if you're refinancing or if you're buying a property, they are asking for what's called an exit strategy. Now, it's not saying that you have to go to a financial planner and get a some exit strategy from them. But what they're saying to us is, okay, well, yes, your client is 55 or 56 or 60. They want to buy a property, no problems. They've got the serviceability to be able to do it, but what's the exit strategy going to be? How long are they going to work for? And if they're going to work till 65, then the chances are that that debt's still going to be there. They're not going to have an income. So, how are they going to actually repay the loan? So we need to be able to talk with people, and put an exit strategy in place so that we can say to the bank, well, yes, these, our clients are, 55 or over, but this is what they're going to do to get rid of the debt, by the time they retire. So interest rates are a hot topic at the moment. All the banks are really going at it pretty hard, and interest rates are at an all-time low. And as I said in the last couple of slides, investors were left out before, and interest rates for investors were higher. And while they're still higher now, you can get a variable loan for about 2.9% interest only. Okay, remember all these rates that I'm talking about, does depend on your serviceability, okay? But, we can get variable rates as low as 2.9. Now, you might say, oh, Joe, 2.9 is pretty high. But you look at last year or the year before, interest-only loans for investors were up in the 4%. So it's all relative, and money is very, very cheap now. And if you've got the opportunity and you can refinance, then that is going to save you a lot of money. Fixed rates, we can get them from 2.49 interest only. So if you're prepared to fix it for a couple of years, 2.49 is available, and I know that a lot of banks are offering that. Whether it's the right time to fix or not, that's something that we do discuss, and we can have a chat. And in the end, it's up to everybody to make their own decisions, because no one's got a crystal ball. I know that Kevin does, sort of send out his, rates notices all the time. So you can always have a read of those and take that advice too, and then decide whether or not, fixing your interest rate is the right thing or not the right thing to do. But like I say to a lot of people, that if you're trying to refinance and your loan to value ratio on your property is still above 80%, then it doesn't really make sense to refinance, because you got to pay that mortgage insurance again. So if you're stuck with the bank and your interest rate on your interest only loan is over 3%, 3.5%, which it can be, then why wouldn't you fix for a couple of years at 2.49? Because you can't refinance. So you can certainly stay with the same bank, and you can still take advantage of a rate cut if it's the right thing for you to do at that particular time. But, as I was saying, if you can't refinance and you can't go back to interest only and you have to pay principal and interest, then, you can get fixed interest rates as low as 2.29. So yes, it is principal and interest, but, these rates are very, very cheap also. And the thing is, we do say to a lot of people, well, if your property hasn't grown in value and you've got to pay principal and interest, yes, it's going to be hard, but at least you're working on paying some of that debt down. And you can still take advantage of some pretty sharp interest rates too. So if you're in that position, give me a call, and we can certainly have a look at the bank that you're with, and we can certainly have a look to see what the interest rates are also. Owner-occupier rates, they're pretty good too. So variable rates, you can the average is about the 2.19 to about 2.5. You can get it a bit lower than that also, but I've just used 2.19 because that's what a lot of the banks are doing at the moment. Sorry, that there should be principal and interest, not interest only. Sorry, 2.19. And then the fixed interest rates, we can get them as low as 1.89. There's a bank that came out today, actually, just now, before we started. I had a look, and they've dropped their fixed interest rate, principal and interest, to 1.79. So again, what we're suggesting to people is, You know, if you've got a home loan, that's a decent amount, 500,000-600,000. You know, a potential could be to maybe fix half of it and leave the other half variable. Now, why would you leave the other half variable? You know, why wouldn't you just fix the whole lot at 1.89? Well, there's a couple of reasons for that. Number one, if you fix the loan, the banks are not going to allow you to make, you know, lump sum repayments off that loan. But the other really, really important thing is that with a fixed rate, 99% of the banks won't let you have an offset account against the fixed portion. So if you've got a decent amount of money that you can put into offset, then fixing half, leaving half variable can be quite good, you know, because you are taking advantage of the lower interest rate, while at the same time you're still taking advantage of the offset option, and you're parking your money in there, and you're going to pay that variable rate down, you know, as fast as you can, and leave the other part fixed, you know, sort of at the lower interest rate. So if you do want to have a chat about that, again, you know, please give me a call, and we can go through those options, and we can run the figures, we can run the repayments for you, and see once again if that's a right way for you to go. So one of the things that we find is that, you know, people burn their borrowing capacity because, you know, when they first start out, you know, they don't know the fundamentals. So in today's climate, yes, the banks will give you interest-only loans, but remember it's for 5 years, okay? So the maximum loan-to-value ratio, you know, if you're buying a property, you want to be able to go with banks that are going to give you 90%, you know, if that's what you want to do, because that way you're using more of the bank's money and you're using the least amount of your own money. Make sure, you know, that the bank, you know, has offset account features, redraw features, because you can park your extra money in there, and you can even put your pay in there and your rent in there, and that's going to help reduce your mortgage down pretty quickly. Fees and charges are very, very important, but from a borrowing capacity point of view, you know, banks that allow negative gearing, so if you've got 2 or 3 properties already and you want to buy a 4th one, banks that actually allow negative gearing are going to be a lot more generous with their borrowing capacity, you know. And so being in the finance game, knowing the banks, we know which of these banks are going to be able to, you know, sort of give you the maximum borrowing capacity by allowing you to use, you know, sort of negative gearing with your borrowing capacity. And lastly, you know, yes, interest rates are important, but some of the other things here, you know, that we've spoken about are probably just as important too. So with the property club, you know, we know that when we do buy a property, your property mentor should be able to do a cash flow for you, and, you know, and that can take some of these features into account. So don't burn your borrowing capacity by using the wrong lenders. Okay, have a look at a few different banks. Now, a lot of times, you know, we don't have the option to go to a few different banks. And you know, if your borrowing capacity works with one lender and it's going to better your situation, then for the time being, you know, that's what, you know, sort of, some people need to do. I know that, you know, I've been talking to a lot of clients for the last 6 to 7 months about the banks easing up with their lending criteria, because, you know, that's what we heard was going to happen. But to date, none of the banks have actually done that. And from what we're hearing, that with the property market around Australia in all states going gangbusters, that the government once again is starting, you know, they're starting to get concerned that, you know, property prices are getting out of control, and they are talking about the banks, you know, tightening up again. So, you know, if your loans are coming out of interest only in the next 6 months, you know, what I would say to you is don't wait until, you know, 1 or 2 months before that. Fill in a finance form, send it through, and, you know, let's see what we can do, while, you know, the actual lending criteria is still quite reasonable with a lot of the banks. So this is one thing, you know, which we encourage a lot of people to do, is get a regular financial health check done. You know, we all go to work every day, we work hard for our money, but a lot of people don't actually make sure that their money is, you know, working just as hard for them too. So, we say to our clients, give us a call every year and let's just have a health check. We're not going to say you've got to refinance, but we might be able to, better your interest rates. We might be able to take some equity out of your property for you. So a couple of reasons why investors do take equity out is number one, they may want to buy another property. But number two, sometimes they may just want a little bit of a piggy bank as a safety net in case sort of things don't go according to plan. So with property prices around Australia booming at the moment, I think a lot of people would have equity. So if that is something that you do need, then give us a call. We can check your borrowing capacity. That does change from time to time. So as banks tighten up, it gets less. But as banks ease up, that there can increase too. So you might have had your borrowing capacity done maybe 6 months ago to a year ago, and you think, oh no, we can't do anything. But there's always new lenders coming into the market with new lending criteria, and your borrowing capacity might change. You may be able to buy a property. So get a regular check done, if you're in the market for a property, and you might be surprised. So ensure that you're on the best rate possible. Okay, so as we saw, there are some pretty sharp fixed rates out there. So if your bank won't drop your variable rate, we get a lot of people saying to us, Joe, we called our bank and they won't drop the rate. There's nothing that we can do. But a lot of people don't consider fixed rates. So once again, no one's got a crystal ball, but if that's going to save your money and that's going to make your situation better, then that could be a good potential option. Is your current lender still meeting your needs? Are they allowing you to go interest only for another 5 years? If they're not, then they're not meeting your need, and you can look around. You can fill your finance form in, send it through, and we can see if there are any other options out there for you. So we touched on this just a little bit earlier. As property investors, it's very, very important to make sure that we do have a buffer. So generally, we say to people, in your savings or in your redraw, your line of credit, whatever, try and have about 2 years worth of buffer sitting in there. And that might, could be $30,000, $40,000, $50,000, because you want to be able to go to sleep at night time knowing, okay, if something happens, at least we know that we've got the funds available to be able to cover that. And one of the really, really important things that people never do is they never ever get their properties valued on a regular basis, okay? Because we all start out and we all want to build a portfolio and we all want to be able to retire on that portfolio. But along the way, people don't actually get their properties valued. And there's a couple of really, really important reasons why, you should get your properties valued, because as you're getting closer and closer to retirement, you need to know, okay, well, have my properties grown in value? Do I have enough equity to retire? Because if your properties haven't grown in value and you've never ever done any kind of any valuations, then you might get a rude shock as you're coming up to retirement. We say to people, just get your properties revalued every couple of years, and that way you can maybe have a graph or you can write it down in a book, so what this property was worth in 2010, then in 2012, 14, 16, 18, etc., and you can track it. And if it's growing, as you want it, great. But if it's not, then, that's when you can be talking to your property mentor or other people, that are able to give you advice, and see what you can do, to rectify or fix that before it's too late. Now, certainly in the current market with property prices booming, I would encourage everybody, to go get valuations done. And a lot of people say, well, Joe, I don't want to get a valuation done because it's going to cost me money. Okay, but we as brokers have the ability to be able to get you valuations, and it's not going to cost you anything at all. So certainly if you haven't had your properties valued, for a while, and you would like to see what they could potentially be worth now in the market, send me an email, and as part of your, regular financial health check, we can certainly do that for you. So that's my presentation for tonight. So thank you very much. So next step, my phone number's there, my email is there also. So if you do want me to have a look at your scenario, give me a call and I'll be happy to have a chat. Thanks, Michael. I'll hand it back to you.
Thanks, Joe. Tremendous presentation, lots of detail, and you covered a lot of stuff in a short period of time, which I think is really good. We do have some questions, and I think it's probably appropriate for you just to keep that slide up for now, so people can, take a photo of your contact details with their phone or write it down. But I might just add, before we talk questions, that when people contact you, Joe, it's not easy for you to immediately recommend a strategy or the next steps without understanding their kind of complete picture. So you'll often go back to a client and ask them to fill out a form, and the property club's financial wealth check form or borrowing capacity assessment form is a form that can be used for that, to provide that snapshot of affairs, and we'll send that through to everyone.
Yeah, so that's right.
You go.
Yeah, so what you're saying is correct, Michael. The finance form is a good place to start because that's going to give us a pretty good indication. But these days it's a lot more complex, and it can take, it can take a while for us to be able to run the figures through different banks, send the scenarios to different banks. We've got to wait till they come back to us, and they may want more information. So yeah, it can take time, and it doesn't mean that we're being slack. It just means that we are trying to do the most due diligence that we can for you to make sure that when we put the application in, that we're not going to have hassles.
Absolutely. So that finance form that the property club uses will be sent to everyone who's registered and or attended tonight. So we'll make sure that people have got the opportunity to have a closer look at their affairs, which is great. So Joe, we do have some questions, which is good. And I wanted to just start, maybe let you draw a breath for a minute, but I wanted to draw on one point. First of all, you talked about interest-only periods. And I know that in the past, we've seen scenarios where property club members have had interest-only periods that have been 10 years in duration and perhaps even longer. Is any of that available even with the lower tier lenders now, or not?
No. For 5 years is a maximum. However, Westpac and CBA, if you've had a loan interest only and it's been 5 years, and you want to switch it for another 5, Westpac and CBA technically will do it for 10 years. Okay, so we've had clients that have called Westpac and CBA in the last few months, and they have extended it for another 5. All the other banks, no, after 5 years, you have to go through a full assessment to see if you qualify for interest only again.
No worries, thank you for that. All right, so we might start with some questions. I think that these questions might be ones that you are aware of. I know the answers to reasonably well. But the first one is, when the bank's looking at a lender's current situation and they're trying to determine, serviceability or cash flow, what are the rates that they're using to assess it? I'm assuming they're not using the actual interest rate that applies on the current loan, but they're obviously using some sort of margin or some sort of rate. Is that across the board? Is that consistent now?
Yeah, it is. Yeah. So if whatever your rate is, it's about 2.5% to 3% higher that they're going to use as the actual assessment rate. Now, if you're going for an interest-only loan, the banks are not going to, to treat your serviceability on an interest-only portion. They're going to go, 2.5%, 3% higher. Plus, they're going to make the repayments principal and interest. Now, because they know that after 5 years, it's going to revert to principal and interest anyway. So they've got to make sure, that they're not going to put you in a situation that's going to put you into financial difficulty. So it's about 2.5%, 3% higher than what you will get.
All right, thank you. We've got some other questions here as well. So, so a general question is, when you're buying an investment property, do you think it's better to go interest only or principal and interest on your loans?
Okay, so part of this is a question for an accountant, but from a broking point of view, if your serviceability is pretty tight, interest only, and you switch it, and we switch the serviceability to principal and interest, we do find that that the people can service the loan. Because the banks, interest only, it does target a higher assessment rate. But the other thing too, though, is that what we do say to a lot of people nowadays is, look, if you can afford to pay principal and interest, then it's not necessarily a bad thing, because you are paying your property down and you're not only relying on capital growth. But interest only is more attractive to investors because, number one, your repayments are lower, and number two, there's a better tax saving if you're going interest only. So again, that's something that we do discuss with people and their situation and their scenario. So there's no clear answer there, Michael, so as to whether you should go P&I interest only. There's pluses and minuses for both.
Thank you. The next question is around the lower rates for the fixed rates, depending on the duration. So I actually saw something on the news tonight talking about how the 4-year fixed interest rates are starting to rise now. So can you perhaps provide some commentary about where you see the lowest of the fixed rates over what period at the moment?
Yes, so you're correct there. The 3 and 4 year rates are starting to creep up. So, which means that the banks, one thing with the banks is that they don't lose money, right? So if they're starting to move their 3 and 4 year fixed rates up, then you know that rates in the long term, are probably going to be higher than where they are now. So probably the 2 year fixed rates at the moment are the ones that are the most competitive. So like I said, for owner occupiers, it's as low as 1.79, and for investors, it's about 2.49 interest only, and 2.29 principal and interest.
Okay, thank you. And do you have a sense of what Kevin's predictions on interest rates are at the moment?
Yeah, so Kevin is saying that interest rates in the next 4 or 5 years are going to go up. So he is very, very careful to say that he doesn't have a crystal ball either. So what Kevin is saying to people, and we may need to clarify this with him, but certainly fixing at a 2 year interest rate may not necessarily be the best way to go, because you're going to be popping out at a higher interest rate. If interest rates do start to creep up. But from a financial point of view, if you're able to save, thousands of dollars over the 2 years because your interest rate's much, much lower, then, I guess that's going to make up, if you do pop out and the interest rates are going to be higher. But once again, that's something that we can talk to people about and just go through that with them.
Yeah.
Because the amount of money that you might save over a 2 year period, on your portfolio, may outweigh, sort of what the interest rates are going to be in 2 or 3 years, 3 or 4 years time, because no one's got a crystal ball. And what I'm saying to a lot of people is, well, focus on on your portfolio today and focus on your cash flow. Just today, we had a person who we've been trying to refinance now for quite a while, but his serviceability was never, ever any good. So, and, he's self-employed and he didn't want to pay tax, so he was showing a lower income. But over the last, couple of years, we've been working with him, and he's been getting his tax returns done, to a stage when, just recently we've completed the refinance, and he's been able to save $42,000 a year in interest. So, and that's on the 2 year fixed rates. So we have discussed the fact with him that rates may, when he pops out, It may be higher, may not be higher. I don't know. You know, I don't have a crystal ball, but if we can save him, if we can save him 40 odd thousand in the next, every year over the next 2 years, that's $80,000 he's going to save in interest, which is going to better his cash flow now, and it's going to make his life much, much easier.
Yeah, absolutely. Absolutely. Joe, I've got one more straightforward question and then a little bit of a scenario, and that might finish us up for tonight. So if I'm renting out my investment property that cost me $500,000 to purchase, and I'm renting it out for $500 a week, and I'm coming back to you to help me to do a refinance of that loan, how does the lender treat that $500 a week rent? Do they treat it exactly as is? Do they discount it? What sort of discounting do they do?
Yeah, so most banks that won't use a full 500 because they know that you're paying, if it's a unit, you're paying rates and body corporates and stuff. So most banks will use 80% of the rental income. So they won't use 100%.
Yeah. And so as a broker, you would know lenders who might have different rules around that as well. So you might be able to put a client towards a different lender with a different approach?
Yeah, so and a very, very good example of this is that some banks double dip, okay, because, we're talking about living expenses. So the banks will use, 80% of the rental income because the other 20% they are meant to, sort of consider that, for rates and body corporates, etc. But a lot of banks use 80% plus they want, bank statements and, rental statements and body corporate statements, for the, people's portfolio, because they also take, sort of that into account too. So not only are they using 80%, but they're also double dipping and using it again. Now, there are some banks that have come out recently and they're saying to us, okay, well, yes, we can see that we were double dipping. However, now, if we're using 80% of the rent, then that will go towards all the expenses for the investment property.
Yeah. Okay, so we'll finish up with a bit of a scenario, which is an investor scenario. So I just want to think this through. So if we've got a couple, a husband and wife, let's assume, with a combined income of, say, $80,000 a year, and Joe, I appreciate you don't have your calculators in front of you, so we won't ask you exactly what the situation is. But let's say they're looking to buy an investment property for, say, $300,000 to $350,000. Could that couple, do you think, borrow at 95% to purchase a property?
Okay, 95% they can't anymore because the maximum is going to be 90%. But 90%, yes, they could. However, it's going to depend on a couple of things. Okay, so if they're a couple, they're on 80,000. Have they got other debts? What are their credit card debts? Do they have personal loans, car loans? Have they got kids? How many kids do they have? What are their living expenses? So it's easy to say, in general terms, on 80,000, if they had a small credit card, if they had no kids, no personal loans, no car loans, then they could do it.
Okay. So let's say they borrowed at, say, 90%, and then they fixed their loan for even 4 years. Okay, so they fixed their loan at a pretty competitive interest rate, an interest-only rate at, say, 4 years. But in 2 years' time, because they've seen what's going on in the property market at the moment, and in 2 years' time, they think our property's gone up by, I don't know, $70,000. We want to pull some money out to, refinance, or we want to pull some equity out to purchase a second property. So how do we deal with the fact that the interest rate on the loan's fixed if they're going to release equity? And how do we go with the LMI question then if we want to release equity in a couple of years' time?
Sure. Okay. So a lot of people think that if their loan is fixed, that they can't draw the equity out of it. Okay, but you can. All right. So if your loan's fixed for 4 years and property prices have gone up, you want to take equity out, you can certainly do that, and that doesn't attract any fees, okay? So the only time you will pay fees on a fixed rate loan is if you break it before the fixed rate period.
Yeah.
So to answer the second part of the question about the mortgage insurance, now, if you've already paid mortgage insurance with that same lender, and your property value's gone up and you want to draw equity out, well, then you can draw equity out up to the 90% again and not have to pay mortgage insurance.
Okay. Yep. Yep.
But
that's good.
But if you want to refinance it to another bank, yeah, well, then you've got to pay mortgage insurance again. And this is something that the government is now having a look at, okay? Because really, there's only two mortgage insurers in Australia, they're Genworth and QBE. So if they've already charged you mortgage insurance one, then it shouldn't matter, if you change banks, because you've already paid mortgage insurance on that property and you shouldn't have to pay it again. So that is something they're looking at, whether, that happens or not, I don't know, but questions are being asked about that at the moment.
Yeah, very good. And I noticed at last night's federal budget, we had some new proposals around single parent households now being able to contribute 2 or 3% as a deposit. There are obviously some rules around it, but that's another initiative that we'll probably see something about in the next couple of months once it gets passed as law.
Yeah, that's right. Yeah. So, which will certainly help, some people get into a property. But just quickly, sort of one other thing for the people out there too is that if you've got a self-managed super fund loan at the moment and you haven't had that reviewed, give me a call, because we've got banks, got a bank now who's offering very, very good interest rates on super loans, and there's hardly any fees at all, because refinancing a super loan, used to be quite expensive. It's $3,000, $4,000, $5,000 in fees, but now those fees are gone and the rates have come right down too. So if you're paying, 5.5%, 6.5% for your super loan, give me a call, because we can potentially get that down to 4.75 for you.
Fantastic, thank you. Oh, well, I might leave it there. I mean, that's been a real download of information for me, and I'm assuming for the people that have joined us tonight. Lots of new information and updates, and I think it's really nice to be able to do this via a webinar, but in a little bit more of an interactive style where people can send through questions. And obviously, some people won't want to send the specifics of their situation through to be discussed, and that's certainly opportunity for further contact with Joe afterwards, but I think there's definitely scope for this on an ongoing basis. I just wanted to remind people that there's other events coming up as well. So some of the people who are attending tonight are in Adelaide, and next Wednesday night in Adelaide, we're running sort of an introduction to property investment course at Theberton. So that would be a good one to go to, as well as that next Wednesday night, the 19th. I think, Joe, you and Roger are running a webinar in relation to the property cycle, the property clock. Is that right?
Yeah, we are, correct. Yeah, so we'll be talking about the property clock. We're showing people, sort of which cities are growing, where they are in the property cycle. And then we'll also be showing some properties in those areas too.
So if people haven't already registered for them and don't know or haven't seen those events, then let us know, and we're happy to send you the links. And just to recap, that we will send you out the Property Club's finance form to each of the people who've attended tonight. So if you want to ask more specific questions of Joe, feel free to call or email, or fill out the finance form that we send you, and we'll use that as the start of the conversation with Joe.
If nothing else, get your credit check done, and we can do that for you for free. And you can see how the comprehensive credit score is going to affect you. So that's the least, that I think we should be doing anyway.
Absolutely. Thanks very much, everyone, for attending, and thanks very much, Joe, for your time and sharing your insights with the group. I hope you enjoy the rest of your night. Thanks, everyone.
Thanks, guys. Thank you. Bye.